Holy smokes, everyone. We have some huge breaking news right now. This is a quick, urgent update. It has officially begun. Like we've been warning about on the channel, it is looking like America is going to be entering into a recession with GDP absolutely collapsing. This is not just something I've been warning about, but also you, the viewers. You've been telling me this already feels like a recession. Some are even going so far to say this feels like a depression. And unfortunately for all these economists and all these analysts on Wall Street, they are greatly out of touch with the average American, with the middle class. Yes, while those that have a portfolio of $1 million plus are living the high life, the average American, even this is happening across the world, the middle class is getting absolutely destroyed by this high inflation. And now the numbers are finally starting to show it. And of course, all these high-flying Wall Street and these economists, these analysts, they're completely shocked. But those that live in reality, live in the real world, are not shocked by this at all. So everyone, this is huge news. Let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, everybody, look at this. US GDP fell at 1.4% pace to start the year as the pandemic recovery takes a hit. And you know, there was kind of a joke going around on YouTube. 2 weeks to flatten the curve, 2 years to flatten the economy. So this was a huge miss off expectations. Look at this. Analysts expected a 1% gain. So what this means is the first quarter, the 3 months, January, February, March of 2022, GDP fell by 1.4% just in 3 months. Imagine what would happen throughout the year if we keep up this pace. Declines in fixed investment, defense spending, and the record trade imbalance weighed on growth. Well, everyone, what is this telling us? This is telling us businesses are not investing. They're saying, you know what, the future does look bleak. We're seeing companies, they're not spending on advertising. We're having a very mixed earnings season here on Wall Street. Some companies are doing okay, while some companies are suffering greatly and their revenue is collapsing. And also what's been happening is the record trade deficits. The US does not make anything, and you know what they say, if you don't make any stuff, there's no stuff. The US has been relying heavily on China and other countries to import all their goods, and all the American economy relies on now is consumers spending. Spend, max out those credit cards. We're all about to see interest rates on these credit cards go up. That's what the American empire runs on, debt. Consumer expenditure rose 2.7%, but that came amid a 7.8% increase in prices. So don't let this number fool you, people. Consumer expenditure is only rising not because of all this demand or because people feel rich and they want to go out there and spend. Consumer expenditure is rising because inflation, the cost of things are going up. So it's not that people are buying more stuff, it's just that the stuff they're buying is getting more expensive. So if we actually calculate inflation, consumer expenditure, in real terms, when you add inflation in, is actually negative. And also this GDP would be much more negative if we didn't have 8.5% CPI and real 16% inflation. But of course, you have all these analysts on Wall Street that are so out of touch with reality. They're saying this is noise, not a signal. The economy's not falling into recession, chief economist at Pantheon Macroeconomics said. Well, his wife must be doing the grocery shopping, not him. So as we know, gross domestic product fell 1.4%, and this is coming off the best performance since 1984. People, what we have to understand, the past 2 years was not the best economy since 1984. You know what we had? The most amount of money printing, the most amount of quantitative easing, the most amount of fiscal stimulus, the most amount of debt put in the economy since 1984. That's what we really had. And you know what's getting laughable right now? Every time central banks pump money into the system, every time they do these fiscal stimulus packages, the stimulant is starting to wear off quicker and quicker. Before, you know, they could do all this money printing and this stimulus and this quantitative easing, hand out all this money, and maybe that would boom the economy for 7 to 10 years. Well, look, it's only been 2 years and the economy is already collapsing once all this cheap money and this cheap debt is being taken away. So let's see here what the experts are saying is causing this recession. While they said rising Omicron infections at the start of the year hampered activity, maybe, while inflation surging at a level not seen since the 1980s, definitely that's what's causing this recession, and the Russia invasion of Ukraine also contributed to the economic stasis. Well, yes, I think what's happening in Russia and Ukraine has added to some of the fears, the uncertainty, and also the recent surge in oil prices and gas prices. That is only the tip of the iceberg from things that have been building up for the past 2 years. The decline in growth came due to the deceleration in private inventory investment, which helped propel growth in the back half of 2022. They say 2022 here. This must be a typo. They must be talking about 2021. Other restraints came from exports and government spending across the state, federal and local governments, as well as rising imports. That's starting to sound more like it, everyone. Companies aren't investing. Investment inventories are collapsing because why would you invest in this current environment right now when you're not going to get a return? Also, what they said there, government spending. Well, they're not handing out stimulus checks anymore. They're not doing all these government programs. They're not paying your mortgage. They're not paying your car loans and all this other debt. They're not doing these child's tax credits. So government spending has collapsed, and this economy was relying on that. So now the economy is taking a hit as well. And to add on top of that, the trade deficit is getting worse. They're relying more and more on China for imports. But what's going on right now with the lockdowns in China, which is getting crazy, is getting out of control. You're seeing people in apartment buildings screaming from their apartment buildings because they can't handle the lockdowns anymore, but they're literally being locked in these buildings. That is going to have a huge effect on the next quarter of GDP growth as well. And if we do have another quarter of a negative GDP, it will be official that the US is in a recession. And I do think this is much more likely than these Wall Street analysts are saying because they have their own self-interest at heart. While recession expectations on Wall Street remain low, which is, I think, for now, sure, once they get this new data, they're all going to be increasing their forecasts of likelihood of recession, there's further trouble ahead for the economy. Effort to combat price increases, the Federal Reserve plans to enact a series of rate hikes amid at slowing further growth. So it's going to be very, very interesting to see. It's almost guaranteed that there's going to be a 50 basis point interest rate hike in May by the Federal Reserve. Now that we've got these figures of the economy weakening, let's see if the Federal Reserve all of a sudden does a U-turn. And if they do a U-turn, this will be good for the markets. But for the economy, I'm not sure how much more stimulus they're going to be able to do without making inflation much, much worse. The current market pricing indicates the equivalent of 10 quarter percentage point rate hikes moves that will take the Federal Reserve's interest rate to 2.75% by the year end. This is crazy, everyone. We're now looking at 2.75% at the end of the year interest rates. Remember when they're saying, don't worry, it would only be 0.5%, 1%, 1.5%. It's going to be very interesting to see if this economy can support 2.75% interest rates, which I definitely don't think it could. Because in 2018 and 2019, the last time the Federal Reserve tried to lift interest rates when the economy was much stronger and there was much less debt, well, it couldn't even handle 2.25%. What is a reputable, safe, and cost-effective exchange or app to buy and sell Bitcoin and other cryptocurrencies? Well, that's where I'm proud to work with today's video sponsor, FTX. You've probably seen many other YouTubers and iconic public figures like Tom Brady and Stephen Curry partnering with FTX, and that's for good reason. FTX is trusted by over 6 million users and is one of the largest cryptocurrency companies in the US. It's a safe and regulated way to buy or sell Bitcoin, Ethereum, and other digital assets. And the reason I love using the FTX app is because it's much cheaper than other exchanges. With no fixed minimum fee on transactions where other platforms normally charge minimum $2 to $3. There's also no ACH transaction fees, and you can also set up recurring buys directly from your bank account for dollar cost averaging strategies like I do because nobody can time the market. They also have a great crypto-friendly debit card where you can spend cryptocurrency at millions of merchants worldwide. They also have a great section in the app where you can stay up to date with the latest news in the market so you can act quickly, and they also have a news feed where you can stay up to date with the latest cryptocurrency projects. If you're wanting to download the app, I'll put a link in the description. When you use code MICHAELCOWAN, you can start earning cryptocurrency for every trade over $10. Thanks for FTX for sponsoring this video. Now, back to the content. And on top of this, the Federal Reserve is going to start selling off its assets of US Treasuries, bonds, and mortgage-backed securities, which is going to make interest rates go up much higher, like what we've been seeing even without the Federal Reserve lifting the federal funds rate. Remember, a lot of banks borrow based on the 10-year US Treasury and these mortgage-backed securities. So if interest rates go up on them, even without the Federal Reserve lifting interest rates, that's going to make the cost of debt go up. And that is very, very bad news for consumers, which of course the US economy relies on consumers and they all rely on debt. And that's going to be bad news for the markets and the housing market. So let's see what Goldman Sachs is saying. They see about a 35% chance of negative growth a year from now in a forecast that is an outlier on Wall Street. But Deutsche Bank sees a chance of a significant recession hitting the economy in late 2023 and early 2024. The result that the Fed will have to tighten much more to tamp down on inflation than forecasts currently anticipate. Well, everyone, I've got to give it to them there. They're saying it is pretty likely, and I'm sure Goldman Sachs, once they get this new data, they're going to be increasing their chance of recession. Now that we're seeing 1.4% negative growth, I'm sure they're going to increase that to maybe 50%. And Deutsche Bank is saying we're going to see a significant recession, and I believe we could possibly see a depression in 2023 or 2024 if this inflation gets worse and they have to lift interest rates above 4%. Again, they're trying to paint this as a rosy picture. That all comes after a year in which GDP rose at 5.7%, the fastest since 1984, while consumer expenditure, which accounted for nearly 70% of the US economy, drove growth in the first half of 2021. An inventory rebuild from the depleted pandemic levels accounted for almost all the growth in final 2 quarters of the year. So what I think is happening, everyone, is a lot of these companies is they filled up their inventories because of these supply chain issues, but they over ordered. Now the inventories are filled and they're not going to want to buy much more products over the next quarter, maybe the next 2 quarters. Let's see how long this can last, and hopefully that does bring down prices. Sustaining that growth into 2022 will require an easing in clogged supply chains and some resolution in Ukraine, which we're not going to get solutions for both of those in 2022, I doubt. Both which will face pressure from high interest rates from not just the Fed, but also global central banks that are engaged in a similar struggle against inflation. That's definitely right, everyone. It's not just the Federal Reserve. We're seeing the Bank of England hike. We're seeing the New Zealand Central Bank start hiking aggressively. And unfortunately, Australia is well behind the curve. So everyone, I hope this is a wake-up call for you right now. If you have not heeded my warnings that I've been trying to warn about for the past year, it is time to listen now. Start paying off high interest debt now. Find a way to start a side hustle. Try to find another part-time job. Find ways to diversify your income through maybe a hobby business, because times are going to get very, very tough. Like I've been warning about, you want to have extra food storage, extra storage of emergency items that you use every day. And you need to start building up an emergency fund right now to weather the storm that is going to be coming. And I apologize if the collapse doesn't happen tomorrow, next week, next month. I know we live in a society where we want things now. We want instant gratification. When we try to put out these warnings, people want it to happen yesterday. But people, the markets don't work like that. The economy does not work like that. And I try to give you these warnings well in advance. But look what's happened now. Everything that we've been warning about, everything that we've been talking about over the past year is happening now. Those that prepared a year ago, they will be fine. But those that haven't, those that left it to the last hour, will get left behind. I think we are living in unprecedented times, and I think this next crisis we're going to face is going to be much, much different, because we have crazy high inflation right now, and also governments are in much more debt, so they're not going to have the ammunition to take us out of the next recession that is going to be coming. And this could be a painful, prolonged recession that could last a very long time. Now, don't get me wrong, there still is a few last tools left for the government and the central banks, but if they use those tools when inflation is crazy high, this is going to lead us into borderline hyperinflation. So everyone, this was just a quick urgent update with what's happening with the US economy, and this will have big consequences for the global economy right when China is falling right now. So what do you think? Let me know. Thanks for watching. I'll see you all in the next video.